morning, everybody. Always a pleasure to be back with you all here at MarketFest. You guys do a great job. And I enjoy, educating traders as well. As Dan said, I think teaching trading is just a great reinforcer of, being a better trader. So not just learning it yourself, but the more you can understand it to teach it to somebody else, I think the more effective you become, because you're really reinforcing what are your rules. A lot of traders make the mistake of kind of knowing what their indicators or their rules are, but then still not following them and ultimately heeding them. And so we want to show you how we can keep it simple here today. And we're going to focus on the Fang stocks. This is really just a key small group of the big tech names that are out there that are really, frankly, driving the market. If you actually go and look at the S&P 500 this year and you say, what percentage of those 500 names are actually driving the S&P's gain for the year, it's shocking that actually about 20% of the names are driving the whole gain for the year, and actually about 10% of those names are driving about 80% of the profits in the S&P this year. And of course, the Fang names are a big part of that. We've had a big run in technology, so we're going to walk you through that, and we're going to show you how you don't have to trade those really high dollar Fang names anymore as stocks. You can focus on the options, particular weekly options, to get the best bang for your buck and still manage your risk effectively. Before I jump into it, I do want to remind you that everything that we're sharing here for you today is for your information and education only. Nothing we're talking about here should be considered a specific buy or sell recommendation on any particular investment. And of course, ultimately, you know that you are 100% responsible for your own investment decisions. BigTrends and the staff are not responsible for any trades you choose to make. And not all BigTrends products or services are going to be appropriate for all types of traders and investors. So always keep your risk level in mind. It's not going to be for everybody. It's a more active approach, but basically we'll show you how we help simplify it and help set up what we call read it to your broker instructions for on the way in, and more importantly, on the way out every time. At BigTrends, we don't provide any personalized financial, tax, or legal advice. We take our research on our Fang names and our options recommendations, and we send them out real time through email and now through text alert to your smartphone over the last couple of years as well. So basically, that's become a real popular feature. So you get that immediate entry and exit guideline, and then you can decide what's the best way you want to implement it. Make sure you consult your tax advisor too before you make any investment that's going to impact your unique tax situation. Now, what are we going to talk about today? As we said, well, if you're new to this concept of Fang, we're going to talk about what are Fang stocks. If you're new to weekly options, you'll learn some of the key benefits of weeklies. But it's especially something, even if you've traded options for a while, I think you're going to learn some new stuff as it relates to why I think the high dollar stocks can give you even better leverage than lower dollar stocks with these short-term weekly options. And I want to get it down to one simple indicator that you can use that we've found tests really well over a large number of stocks, in particular the Fang stocks, to define trends in stocks, particularly the starting point of a trend. I know a lot of you know how to identify trends out there, but the question is, are you identifying them early enough so that you're not getting too late in on a move, and then by that point, most of the potential is out of the move, and now you're taking on too much risk. So we want to show you an indicator that's going to show you how to get on reasonably early, not too early, not too late, kind of find that sweet spot, that in the middle of the trend that's kind of the easier, more consistent part of the trend. And also, I get a lot of people that are asking about income streams. How can they create a stream of income out of any given method? And actually, we'll show you how you could do this with our Fang options trader system as well. Now, let's get into, first start at the beginning. What are Fang stocks? Now, the traditional Fang acronym was, I think Jim Cramer gets the credit for initiating this idea that Facebook, Amazon, Netflix, and Google are the original Fang stocks. And, they're all disruptors in some way of something going on in the world. If you look, or some whole new industry like Facebook with social media, Amazon, of course, disrupting the entire retail space, now offering everything delivered to your doorstep. Netflix, of course, disrupting the whole broadcasting model to give you content on demand and binge-worthy content that you can get hooked into and view it at your own schedule. And then, of course, Google, parent company is now called Alphabet. They renamed the stock a couple years ago, but basically, you don't alphabet something when you go search for it online, you Google it. So we still use the G in Google for that Fang acronym. And then the bonus one that we add, and it's in the news, of course, today and after the earnings yesterday, is Apple. with another monster earnings report. The company reporting $260 billion in cash. Even after their debt, that's still 170 plus billion that they have in cash reserves. So we're going to talk about Apple as really the kind of fifth component of the Fang universe. And that allows you to really focus on fewer names. So basically, these are very active liquid names in the stock market, and in particular in the options market. So when we go in, we know it's not us trading against a market maker, it's us trading against a lot of other traders. And that's the kind of situation you want to put yourself in as an options trader, is very active optionable names. Now, also, what we want to focus on is, okay, what's the easiest, simplest strategy to get in and out, and also make sure that we can get an effective result out of it. Now, why should you care? This is our result since we initiated this a year ago. You can see here, we started this off here, and these just show you the combined of all the wins and losses added up, the total gross profits or losses in red. So we've had 9 out of 12 months profitable, 75% profitable months. And in particular, what I want to talk about is, okay, if you were thinking about, say you were looking at starting with a $10,000 portfolio, you could do this with a lot less. We will only carry 2 Fang names open at one time, and we tend to recommend on a $10,000 portfolio, we wouldn't be putting in more than 10% of our account into any one trade. That would be $1,000 a trade. So theoretically, you could do this with just a few $1,000 basically if you wanted to. But we use a model portfolio example at 10,000 and say, okay, look at how many months you could have written yourself a check out of those out of those profits that you're making. And so, you've got to look at it and say, okay, if I'm making money August, September, October, the first step I would say that gets a lot of traders in trouble. I want to talk about some of the psychology elements too, because having traded myself for over 25 years, once you get the clean system in place, then it's basically just managing your internal state and your internal emotions. A lot of people after those kind of gains, up about 2.6%, 8.9% in September, 5.8% gross profits in October. And of course, if you're paying too much for commissions, check with us. Chris Sarah, who's in with me to help answer questions, can get you pointed to brokers that can help you get your commissions down, but also get you in and out of these trades automatically if you're afraid of missing trades. But bottom line is, a lot of people make the mistake after a few months of gains of loading up and starting to double up their commitment or what have you into each trade, and then they'll go through a down month like November. And so you see November gave back the October profit, if you will. You're still nicely ahead of the game after the November loss. But the way I look at it is, if I was taking money out of my account every month, those first 3 months, then I'm going to be down a little bit in November. Obviously, I'm taking nothing out in November. After taking out, you can see a combined $1,500 plus of gross profits. But I'll take 0 out in November, and then December I'll take 0 out because I basically am making up for that give back in November. So if you're thinking of this as an income strategy, the way I look at it is, you can write yourself a check still in the majority of the months, but I want to not ever cut too far into my capital base. So always, just like Warren Buffett would say, the first 3 rules of investing are protect capital, number 1, number 2, protect capital, number 3, protect capital. It's the same idea here, that if you're writing yourself a check without saying I don't have to ramp up, try to keep compounding my profits. A lot of people get kind of seduced into that concept. I'm just saying, just take it more from like an income stream approach. Say, let's keep it consistent on the amount we apply through both up and down cycles. Everything's going to have up and down cycles. If you're not prepared for that, then basically you're going to give up after a little brief down move, right? The big thing about this Fang system that I like, and I'm going to show you as we go here, is that it doesn't get you into a big drawdown on a given trade. As long as you avoid event risk. We've had a lot of earnings in the last week with the Fang names, and we stayed away from that because we don't want to try to play for gaps that could move against you as much as for you. So, and the options are expensive when you do that too. We wait until after the earnings are behind us, and then we continue trading our Fang names with our systematic approach. So you see, you'd then be starting to write yourself a check here. You'd write yourself another check here after you made up for that November loss. You'd write yourself a check for the difference here of $576 gross profits that you're coming back. Now, February, you're down 148, so you've got another no check you can write yourself in February, but then March makes up for that by still a net of more than $1,000. You'd still be up after you take back that $148 loss, keeping your capital account the same, not letting it get cut into, you're still up what, a thousand and about $1,046. Okay, so look at it like, okay, how much could I write out? And then April, I don't write myself anything through a choppy month there, but then basically in May, you can see I'm making up that 290 plus, and I'm paying myself back 538 in May. And of course, June and July, you see, have been fairly steady. So again, if you're thinking about a $10,000 portfolio, you say, well, what percentage would I be making a month? Like, we get that question a lot. So you're thinking, well, I could be making anywhere between 2, 3, 5%, sometimes 10% on that money. And of course, if it's less than 10,000, it could be an even bigger return. But just you can see there's a few months where you're going to still have to wait. You can see you'd have basically a total of 4 months where you wouldn't write yourself any check out of that 12, and then you'd be protecting your capital base, so you're not digging deep into your starting stake. That's important. Always manage that, and we'll go back into that a little bit more. Now, we just had through the 10 months. I didn't update this chart, but actually, this chart of $3,896 is now up to something more like $4,400 plus. So basically, in 10 months, if you were starting with, think about that. If you're starting with a $10,000 account, if you're up 4,400 plus in gross profit, that's 44% annual profit over the last 12 months. And then even again, if you factor your commissions out accordingly, you're still up way above the market. And that's what we want. We want someone that's going to help you beat the market and, more importantly, manage the risk. So I'm going to talk about that here as well today. Now, when I look at this and say, okay, I want to know a little bit about you. I want you to say, tell me what kind of a trader you are as to what's your typical preferred time frame. I've got the day or even quick trader as the number one category. Type in the number one if you're in that 1 or 2 day category. If you're more swing trading 3 to 5 days, type in the number 2. Position trader 1 to 4 weeks, type in the number 3. And I think we got a pretty active group with us, as I know Dan had mentioned. Do a lot of day trades through his methodology there. But bottom line is we do have some swing traders as well, and a few position traders even. Obviously, we're not getting into the buy and hold mode, passive investing. I don't want you to be passive. I always want you to be proactive. But, we get some active investors in there as well. But most of you are telling me day and swing trading. That's good, because most of what we're doing here is actually over anywhere from 1 to 3 days. Now, when we do have a couple of day trades in a given week, we're sensitive to that. And you're not going to see us ever do more than 3 day trades in a given week. Most of the time, that's not going to be an issue. But if we see that happen, we'll basically back off from making another trade until we get through that 5-day window. So that way you can still do this active trading approach with Fang options with a small account. Because obviously, if you start doing too many day trades, if you have a real small account, then basically they're going to lock you up and not let you do trades until you boost it up on your account value. So we're sensitive to that. We want to let small accounts participate in this just as well as bigger accounts. So day to swing trading is really the focus that we're using. Now let's get into some of the indicators and tools that we're using through this Fang options trader approach. I use a lot of different trading platforms. I'm not dependent on any one, but certainly I've been using TradeStation since the early 90s and its predecessors. I've always liked the technology of being able to write my code, test it, and tell me would I have made money over a large sample of trades or would I have lost money. I want to know that on the front end, and we'll show you an example of that so we know we've got an edge. Thinkorswim, of course, is another one that's really burst on the scene in the last decade, and Metastock has been around for a long time as well as platforms that give you a lot of that coding and specific buy and sell arrows that makes it easy to execute trades. I'm all about keeping it simple. The KISS principle to me, you'll see we come back to that again and again. Now, within our Fang options trader system, what we're really focusing on here of these key components is this indicator that Wells Wilder developed called the ADX, which is the average directional movement. It's a function of the DMI lines, the directional movement, and what's called the ATR, average true range. I'll give you a little education on that as we go here to kind of give you a little background on that. And then we do filter with a longer-term moving average. So we don't want to take short-term buy signals if we're below a longer-term average. And likewise, I don't want to sell a situation if we're above the long-term average. My experience is that if you get a conflict between your short-term and your longer-term time frames, usually the long-term time frame is going to win out. So you don't want to get faked out on what looks like a breakout. You want to stay with the true breakouts and miss a lot of the fake outs. So this creates kind of a trade funnel, if you will, where we're narrowing our focus. I'm here in Kentucky in thoroughbred horse country. My family's been in the thoroughbred business for generations, and basically in the horse races, you may see some horses that wear what are some called blinkers or blinders. That basically they've got this kind of focal point around their eyes so that they can't stray their vision, that they're really focused straight ahead. This is the same kind of approach with this trade funnel. I want to narrow it down. That's why we're only looking at 5 names out of basically more than 4,000 plus optionable possibilities. We want to focus on 5 key optionable stocks here with the Fang names, and the trade funnel that I'll show you here today helps you do that. Now, from the perspective of how we want to go and build this backdrop, let's start with Wells Wilder. This is the same guy, true technical innovator, who also invented the RSI indicator. I know a lot of you know the relative strength index, overbought, oversold indicator, and he also developed this whole concept of DMI, directional movement index, looking at basically net new highs and net new lows. Now, one of Wilder's innovations at the time was that in the day, this is going back decades, okay, decades ago, people thought of a stock's range as its basically high-low for the day range. And Wilder said, hold on, we're missing something in looking at that range, which is what? He said, let's just draw in an example here. So if you look at your typical bar chart, where you look open on the left side, you close on the right side here, and you've got your high and low typical range. And then you look at, say, the next day here, say we open at the middle point of that day's range, we close at the midpoint, your little candlestick doji pattern, if you will. Wilder would say, well, most people would call that second day's range the high to low. We'll call that R, okay? So he would say that most people are looking at the range. And Wilder was saying, you know what they're missing? They're missing the gap from the prior day's close. He would say that that's essentially when you get gaps, you need to consider the low of the range off of that prior day's close up to then that high in an uptrending gap situation. So the true range, as he called it, we'll call it TR, would be the day's high low plus any gap added in this case. So that's a bigger range you can see. And by definition, the true range is always going to be either the same if there's not a gap as the high low range for a bar, if you're talking about no gap from the prior day's close, or it's going to be bigger than that actual high low range when you factor in a gap as well. So the true range actually is expanding the concept of how much real movement are we getting. If you're trading stocks or options or any vehicle, really, you're looking for movement in your favor, right? And so the bottom line here is that we've got to focus on the more movement. And for me, the true net directional movement of an uptrend, of course, is when you're seeing something that's basically making higher highs and higher lows for an uptrending pattern. That's going to be a big plus, right? Or if it's making a lot of lower highs and lower lows, that's going to be a big minus. If it's doing a lot of chop back and forth, I'm going to call that a question mark. I don't want to trade question marks, okay? That a lot of people like to try to trade that buy the low, sell the high in a range, and then all of a sudden it breaks out against them, and then like, now what? So I try to avoid those uncertain periods, and that's what the ADX will help us do as well. We'll get into that here in a moment. But so if you take an average of all this day-to-day true ranges, it shows you how much total movement you're getting over any given past look-back periods. Okay, so total movement's one thing. Like I said, you could have a lot of total movement in that question mark scenario. I'm not interested in total movement. I'm interested in this last little piece here that we call DMI, the directional movement index that shows you net new movement. Okay, so we're getting incrementally higher highs and higher lows, or for an uptrend, that's going to be something you want to figure out how to get a piece of that trend phase, and that's what I want to look for. I'm looking for trends here. I'm not interested in range-bound, questionable activity, okay? So that's why, a lot of people that say just focus on price action get whipsawed a lot when you go through the range-based phases. And so for us, it's really being incredibly selective. You're going to see when we show you these chart examples how there are windows of time where we can be in these really good trend phases, and then if we get knocked out, we'll probably wait a while before we come back to the next opportunity because we got to get the right setup. Now, we're going to talk about setup in a minute, but first, a little more about ADX. Essentially, what ADX is measuring is essentially the positive and negative directional movement lines, and when you start to see that you're getting a lot more new highs, the DMI plus is going up, and the DMI minus is going down, that means we'd be in a better uptrend, and the widening gap between those DMI plus and minus lines, as you'll see in the chart examples here in a few minutes, is exactly what is going to pull the average directional movement up, and the ADX going up is what actually shows the trend based phase kicking into gear. If ADX is going down, it means you're in a non-trending phase or a less certain phase, and you want to stay away from that. But it's not just ADX going up that matters. I'm going to show you a very specific pattern. You know, I promised that I was going to give you really good education today, and I'm going to give you something really specific you can actually apply to any time frame chart when you see this pattern in action. Now, again, directional movement divided into the true range gives you a percentage, essentially, that makes the directional movement for that stock relative to its true range. That basically gives you a percentile, which is what we're going to measure ADX on, and we can then compare apples to apples or Facebooks to Facebooks or any combination of stocks to each other to get which ones are giving us the best ADX patterns, okay? Now, before I go into some charts, I also want to talk to you a little bit about options theory. You know, I've gained a lot of acclaim for you know, teaching people about options and different option strategies that can be effective for you through all kinds of different markets. And one of the things I think is widely misunderstood is, you know, when you look at low dollar stocks versus high dollar stocks, there's some real opportunities that arise. Most people would just assume if you're talking about a $20 stock and you're talking about a $200 stock, that's just going to be a factor of 10 and everything else should be pretty much equal. But let's look at an example here where let's say you look at, you know, a stocks at 20 or stocks at 200 in orange on the right side here, $20 stock in green on the left. And let's say that each stock rises 5% in 5 trading days. Now, if I said I want to buy each option a little bit in the money, in this case, I'm going to go about 2.5% in the money. So meaning that, okay, for a $20 stock, I don't want to buy the 20 call. That would be at the money. I'm going to buy an in the money, say 19.5 call. That's up. We call that a $half in the money. Compare that to, okay, if I buy the same 2.5% of the money in the $200 stock, that means I'm going to buy a $195 call. We're assuming that each one's got about a week to go for expiration. So we're in that weekly final last week of an options life when we're looking at that move happening over 5 trading days. Now, if you're looking at the options pricing model and you go plug in, okay, so what are we going to have to pay for each of these options? You know, we're assuming the similar volatilities, so we're trying to keep everything else equal in the options pricing model. So we say, okay, you know what? If you buy, you know, a half point in the money, but still with a week left on the low dollar stock, the $20 stock, saying that those options are going to cost $1. That means $100 per contract, $100 to control 100 shares. That's still tremendous leverage, right? But if we do the same thing with the $195 call on the $200 stock, it's telling us that it's going to cost us $5.50. Now you say, okay, that's a lot more, right? But it's not 10 times more. Because basically, as you're going more in the money with so little time left, it's saying that you lose a lot of the what's called the theta, the time decay rate, as you go more in the money on that high dollar stock. Yes, it's going to cost you more per contract, but it's still going to be an important differential here. Look at the difference on how much net time we're paying for, essentially. If you buy the 195 call for $5.50, you're only paying a $half out of that $5.50 in what we call time value or extrinsic value. 5 of that 5.50 is intrinsic value. That means if nothing happens, the stock stays flat at 200, then basically you're talking about losing right around just a hair under 10% on your investment if it stays dead flat. What happens on the $20 stock if it stays dead flat? Well, half of it's intrinsic value, but half of it's that extrinsic time portion. You'd be risking 50% time decay in that example. And of course, as a result, that means your delta, which is how much the option is going to move for a 1-point move up in the stock, in this case would be only about 65% on the 19.5 call versus it's a delta of about 90% on the more high dollar 195 call. I want to compare them against each other with similar dollars. So I usually, like I said, we do about $1,000 into the trade here. Since a $5.50 option would only get you 2 contracts, I said, well then fine, let's compare that same $1,100 investment on the left with $1,100 investment would get you 11 contracts. So both of them you invest $1,100. And again, let's say that you're betting on a 5% move. So on the stock in green on the left, it goes from 20 to 21. At 21, what's a 19.5 call worth? At expiration, it's worth what? It's worth $1.50, right? You have a right to buy at 19.5. You can sell it at 21. It's worth you bought it at 1. It's worth 1.5. That's a 50% gain or $550 gross profit in that example. Now the same example on the right, if you take a 5% move from 200, that's taking it to 210, correct? So 200 to 210, what's a 195 call worth at 210? It's worth 15. So now that 15 on 2 contracts over here is now worth what? It's worth $1,500 times 2, 3,000 bucks minus the 1,100 you paid. That's a $1,900 gross profit. That's 173% gain in the high dollar option example. Why is it so extreme of a differential? Because of course, yes, that high dollar stock, those small dollar by dollar moves make a basically a bigger impact, especially when you're able to buy such a nice intrinsic value, very little time value situation. You're getting incredible bang for your buck. When you pay too much time, that extrinsic or time value portion is what you want to avoid. That's what basically makes it less profitable for the low dollar stock on the left. Okay, so keep that in mind, because that's why we're saying with these higher dollar Fang names, we're going to get a lot more bang for our buck with those in the monies when we can. Now, we have another rule though, because we know a lot of people will start off trading this with maybe $1,000 per trade. So one of our rules is we can't pay more than $10 for the option, which is $1,000 per contract to control 100 shares of stock. Now, again, even if you got a one contract investment on a stock that's trading at more than $100, you're still getting huge leverage, obviously, even with just one contract at a time. But we do want to make sure you're participating in each trade as we get these signals, because we play the probabilities. We're not trying to go out there and say, load it all up into any one and then back off of these others. Our system says, look, we've got to take every new setup as a potential opportunity, knowing that some will work and some won't, but we're playing that probabilistic edge over time. So every time we get a signal, we're firing out a new trade alert, and we're telling you also, more importantly, not just when to get in, we're telling you every time when to get out. So we get a clear exit in each case. Now, let's show you this pattern here, okay? So now we get into a picture's worth 1,000 words, right? Let me show you how this ADX works here. Now, on the bottom panel here, we've got the ADX in green, okay? So that's the main line I want you to focus on. But it is in relation to the other DMI lines. We got the DMI plus here. I'm just going to write a plus, D plus on that, on the blue, and then we've got D minus, directional movement minus here in red, okay? So basically, what I want to also see is that we're coming out of a period of basically no trend, preferably, or no clear trend on this example, and so ADX, you see, was drifting down the green line below both of the DMI lines. So one of our important patterns here is that as we turn up in ADX, it's not just a turn up in ADX we care about, but ADX should turn up and cross above whichever line is the declining directional movement. In this case, it's that we're getting less negative directional movement as the stock starts to shoot up to the upside. And of course, a positive directional movement in blue is going up. That means you're making net new highs. We're not making as many new lows. So as you make less and less new lows here, your directional movement in red is going down. That's meaning you're making less new lows. So more new highs and less new lows means that gap between those DMI lines is widening, and that's what ADX is picking up, is that we're getting into a trending phase, higher highs and higher lows. And you can notice that we get our buy signal here circled on that second half-hour bar here on Facebook. We watched the 30-minute chart to try to minimize some of the noise of those shorter-term time frames, but still have it be very responsive for quick trades over an average of a couple of days. And you can see here that ADX starts going up. Now, what's our exit rule here? Some people ask me, well, what if the positive DMI starts coming down? You can see it starts drifting down later that day after we got our entry on Facebook. You can see we got our entry on Facebook around 127.5. We bought the 124 calls in the weekly options with just about a week to go for just barely over that 3.5, 390. So you can see, again, we've got about 90% intrinsic value, about 10% time risk. And that amounted to a 74% gainer the next day when we closed it out. Now, it's not the DMI line coming down under the ADX. And if you had gotten out there, you can see that would have been a premature exit, because essentially, yes, we flattened out a little bit later that afternoon on Facebook after the big run in the morning, but the ADX line was still going up. So what we care about is when the ADX line starts to roll over, you can see once it rolls over, that gives us our exit. So that green line going down into the following bar, we're really picky about that, because there are times where you'll see that it'll keep going up eventually, but the trend is slowing down at that point. It's becoming less clear. Like I said before, we're just looking for that sweet spot where we can trade and really be on board for that good phase of the trend. So So, again, Facebook, what did it do? It went from 127.5, and you can see we're not perfect. It went up to about, 131.5 or so that next day. It started to pop up. We're continuing to ride. Obviously, we're up in the neighborhood of about a double near the peak, and we get out about plus 74. That's the normal kind of, you're going to have a little give back once the trend ends. But the danger of trying to pick that top, I know a lot of people say, I'll just take a 30% gain, and they leave all that other upside on the table. And so, we know that in this trend following methodology, it's these outsized gains that while they don't happen all the time, they're the ones that drive your portfolio. So we get our share of, quick stop outs, down 10, down 15%, up 5, up 10, those that just didn't really fire in a big way. And you've got to be around and stay with the system and the signal to give yourself a chance for the ones that can go on to near doubles, because those are the ones that even on a small investment per trade are going to basically carry your result. Okay, so don't cut your winners short. I know a lot of traders that are making that mistake these days because they've gotten burned in the past. They thought, well, you can't go broke taking a profit, but if you take small profits and then you end up taking bigger losses, that's not going to be a good system. So this system really gets you in for that good phase. And then you see what happens. I didn't mention before, but we have our moving average filter here in this kind of maroon color line. It's a little harder to see, but you can see that it was positive through that entire phase. It's going up. That means a longer term trend, which longer term is relative, right? On a 30-minute chart, we're trying to tie that in with about the last month's activity on that moving average filter. And you see what happens there and later in this chart. You see, well, should we get in when the ADX starts turning back up here? This last bar is starting to head down. You can say, well, gee, that ADX is turning up again. Shouldn't we get a piece of that? The negative directional movements above the positive, isn't that a downtrend? And you can see that, yes, while it is a downtrend on just a simple ADX, it did not cross once they were, ADX was not below both when it crossed back up. So basically that means it's a less certain downtrend, and the moving average filter says be careful. You can see it did actually trade down to the moving average, and then of course by the time it flips back up, throwing over just later after this chart, you're not going to make as much, and it's going to be risky in those situations where you see that it'll bounce hard or even gap against you that next day. We're really trying to make sure that if we're going to have gaps that we think they can be in our favor more than against us with this powerful ADX trend working for us. Now, one of the real things, if you read a lot of the classic textbooks on options, they will tell you that what's the one thing that you don't know in the options pricing model. They'll say that the one thing you don't know is volatility, or what people call implied volatility. And it's true, you don't know what the future volatility for that stock's going to be. But I contend that the options pricing model makes a mistake in just assuming that the stock price going forward will be the same as the stock price is right now. It's basically saying there is no trend, and I believe that your edge as an off-the-floor options trader is actually to focus on these situations with strong trend. The higher the trend in your favor, the more of an edge you're going to have against a traditional options pricing model. Now, if you don't believe me on that, if you study the options pricing model, I would say look at who developed the options pricing model. You probably heard of it, called the Black-Scholes model. These guys in the 70s did groundbreaking work to give market makers essentially a guidepost on how to value an option. They actually won the Nobel Prize for the options pricing model. Several of them did, not just Black and Scholes, Merton as well. But basically, two of those three guys went on after their Nobel Prize in '97 to found and be a part of a big hedge fund. Does anyone remember the name of the big hedge fund that they were a part of that actually went through incredible problems into '98 and actually about took down the financial system because of the insane leverage they were using? And basically, you had to get the Fed and a bunch of banks to bail them out in '98. That's right, Rick. LTCM, otherwise known as long-term capital management. This was considered the best and the brightest minds in the business, and they basically blew up like trillions of dollars of notational value in these options and swaps they were trading because they didn't believe in trends. They believed that every move that goes up must come down, or every move that goes down must come up. And it's the theory that's called mean reversion. Now, mean reversion in a true long-term sense can work, but as they say in the classic trading lingo, the markets can remain irrational longer than you can remain solvent. Okay, long-term capital management found that out as Wall Street realized they were in trouble and kind of pressed the bets that long-term capital management had against them to where they blew out, and the big banks had to come in and bail them out along with the Fed. In fact, a little history lesson, one of the banks that didn't agree to come on board was Bear Stearns on that bailout. And guess what? When Bear Stearns blew up in '08, nobody came rushing to their rescue. So it's a reminder that the markets, as well as your friends, have memories and basically will remember when you backed them up or when you didn't. So Bear Stearns paid the price for that. Interestingly, too, Lehman Brothers at the time in '98 was rumored to be insolvent because of all the short puts that they had basically let long-term capital management take on over at Lehman. And then when those things went down hard, Lehman was on the hook for a lot of dough that they couldn't come up with. And so Lehman benefited from that bailout, but of course ran into the same trouble in '08 when they went belly up as well. So the bottom line here is that, yes, you want to focus on this very, very closely, that the high trend is where you have your edge. So when you're not a market maker, the market makers are benefiting from that thing called the bid-ask spread. That's how they get paid. That they're buying from people a lot of times at the bid, they're selling to other people at the ask, and essentially making that spread, that difference. But bottom line is that the solution that we have is you should focus on the strongest trends possible. That's what this ADX system shows you, that you're getting the trend kickoff phase, and you're getting the bang for your buck with a more in-the-money option whenever you can. Now, because Amazon and Google, for example, have run up near $1,000, give or take, sometimes we have to buy things that are a little closer to the money on those, but that just means we're going to be very tight in our risk management. We'll talk about risk management here in a minute as well. Let's look at another chart. How about one on Amazon from its charge up towards $1,000? This one was back in March, where you can see we were getting a buy signal on Amazon. It's about $855. Now, you notice it was several, 4 bars actually, 4 half-hour bars into the start of that new session. It gapped up. We don't just chase gaps, because you see what's happening. ADX is starting to lift a little bit, but it's still below those directional movement lines. It finally crosses above the declining negative directional movement line, meaning you're making more and more new lows, and DMI positive is still staying firm up here at about 855. Now, you see, we were able to buy an 852.5 call. That's about 2.5 points in the money. So we're still paying a chunk of time here, but we know that we want to make sure that we stay with it only while ADX is rising. If it's flat, that's okay. But if ADX turns down at all, 1 half hour versus the prior one, we're going to be out. You see how ADX starts to, when Amazon later in that first session starts to consolidate, has a brief little few red candles down. A lot of people would bail on that into the close, but notice, it was going up and it kind of flattened out, but it did not go down. And then you see what happened. It pops up and it keeps charging ahead the next day. So we were out of it once it rolled over here on the start of that third session and said, okay, at that point we're out. Now, you would say, okay, and you were above the moving average filter. You would never take a short signal above that because of the positive moving average. But this is an example where, Amazon eventually charged on up above $900. So it's one of those that if you bet on ADX turns as a reason to trade the other direction, you're making a big mistake. The directional movement lines you can see are still positive as above negative. Okay, so that would be a first tell. You never would want to be bearish when the directional movement line is net positive like that, even if ADX is rolled over. So keep those directional movement lines on your charts. That's what makes them useful, not just looking at ADX by itself, but ADX relative to the directional movement lines. I added that in long ago because a lot of people used to criticize ADX and saying, sure, ADX shows you a trend, but it doesn't tell you in what direction. And I said, well, I can fix that real quickly by putting the directional movement lines and tell me real easily, is blue positive above red negative? That's telling me where the bulls are in charge. If red negative is above blue positive, then the bears are likely in charge. Okay, so that's the kind of thing that we're going to look at here. So from this perspective, Amazon, very good to us. Look at the end result, 168+% in just a couple of sessions after we got in. So, you don't have to hold these for very long, and that's why we can use weekly options. Because the weeklies with this approach is basically the idea, why would you buy an asset, why would you buy the stock when it's a lot cheaper to rent or lease it with that in the money or short-term weekly option up to but no more than $1,000? That's where your real leverage kicks in, because you're paying such a small percentage to control that very high dollar investment you would have to make in 100 shares of stock. Google is up above 860 now, but back when I was starting to talk about this concept earlier this year, I was saying, look, you would pay $86,000, or like with Amazon, nearly $100,000, give or take, to control 100 shares of stock. We can control that same 100 shares with one call option and pay no more than $1,000. So 1,000 on 86,000, 1,000 on 100,000. You're talking about 1 or 2% kind of potential leverage. Even on names like Apple, we're going to look at these current charts here as a bonus here before we're done. These are examples where your leverage potential is, anywhere from 50 to 100 times in most all these situations that we're looking at here. Okay, so speaking of Google, like we said, parent company Alphabet, this is a great example where Google was marginally positive these first couple of sessions that I'm going to block out here, but you see ADX being below through that whole phase means that I would not ever consider trading that, even though you say, well, DMI plus is above DMI minus for part of that, whatever. Bottom line is that's whipsaw potential. Those whipsaws, those fake outs, don't only damage you potentially financially in your trading capital, they damage you psychologically when you have too many fake outs. You start questioning your methodology, questioning if it's the best system for you, and what happens, you start risking giving up right when you should be focusing on the next new opportunity. You can see it starts to lift off there later in that session on the 21st. And you see what happens here is that when it crossed up, it's happening right near the end of the day, and we're getting an alert out to our subscribers and through real-time email and real-time text alert. Google is about 805. We're buying an 802.5 call for 850. Okay, so that's $850 to control $80,000 worth of stock. That's why when it popped the next day and then it did roll over, very, very small rollover, but hey, any rollover to us is enough to say get out. It was up to about 817. So what's the stock move there? 805 to 817, 12 points, about 1.5%, and our options gone up 88%. So you can see you're pushing near 50 to 1 leverage, even 60 to 1 leverage, actually close to it, in that move in just basically less than 24 hours, but 2 trading sessions. So that's not a day trade, even though it's a very short-term trade. It's basically geared at finding where the opportunity is setting up. You can see, again, when ADX starts to cross up again and it looks like the DMI lines are turning the other way, would we take that? Of course not. We're still above the long-term filter. Good thing we didn't take it. It held that long-term support and then shot up against the other direction the next day. That would cost you if you were trying to trade any ADX upturn. We're looking for a very specific pattern. What that ADX pattern does for us is it really allows us to manage our risk a lot more effectively, because I really believe we're getting in earlier in a new trend. And you know how it is. A lot of other traders feed off of each other. If you see something happening because other traders are doing something, it becomes kind of like a self-fulfilling prophecy that people want to buy things that are going up. The old Will Rogers thing, if it ain't going up, don't buy it, right? So they don't want to buy things that are going down. They want to buy things that are going up. So this short-term momentum kind of strategy works because you get that self-fulfilling pile-on effect once you get a really good kind of kickoff pattern like that ADX cross that I've shown you here today. Now, but you want to make sure, I don't care how much money you made off of however many trades recently, never load up on that next trade. Always basically look at it like a probability game, because there's going to be times where it doesn't work too. We'll show you when we go look at the live charts here before we're done to kind of give you a quick little lightning round look at the big 5 Fang names. So make sure you stay proactive, and also make sure you stay disciplined in not chasing after anything here. So, and Raj asked about parameters. We give all the parameters, all the setups for all the filters and everything to all of our subscribers once you come on board. And I'll tell you about how you can benefit from that real quickly here in a few minutes. But here's a prior example with Google. We bought a 975 call. We had to pay a little more, 960 on that here just recently. That was on July 18th. And you can see that was well enough in front of the earnings that we could trade the weeklies the week before those earnings were going to hit. So we didn't have to pay up for those option premiums, and we were in and out that same day. Now in this case, we do have a trailing stop. This one we put in as well in these really high dollar names, because we don't want it to give back more than 30 percentage points from the peak. So that first nice lift it had was great, but that bit of a comeback down was basically a trailing stop hit. We could have made a little bit more by the next day when the ADX was rolling over, but we did find that putting a trailing stop in is a good risk management discipline so something can't get wacky on you intraday. And you see also here a downside example. I'll show you some bull examples. What about on the bear example? Here's one where Google rolled over, gave us that ADX cross right as it broke the moving average filter. So it only has to be below there at the point of the ADX cross up. Okay, in this case now you see the DMI minus is above the DMI plus. So you see the difference here is that, okay, now the bears are taking the ball. And you see it's steadily working in our favor over the next day and a half. And then you see here's where you get that ADX rollover here as it starts to turn back up. Now you can see in retrospect, the DMI lines didn't cross back up until a couple days later. This is right at the end of the year, start of the new year. But if you'd waited to that point when it crossed back up, you'd have given back some of your profits as well as leaving the position lingering for too long. So just because it's below the moving average filter, there's going to be times where you get that noise where it's going to want to retest back into that. Now, I mentioned Apple as well. We're going to look at the live chart here in a minute on Apple after I talk about weekly options next. But basically, you can see here that here's a great example how in the money we can go with Apple. Apple giving us our signal here. This was in May. And you can see Cinco de Mayo, good to us here on May 5th. We're after, notice that ADX is dipping. The green line is what you want to look at there first. And you see all that chop back and forth. Put exits through all that, right? Don't trade that because basically you're going to get whipsawed and you're going to give up when you should be getting ready to pour to pour into the new trade here with our typical allotment right on the gap of the first half hour in. That will happen on a really strong gap sometimes. So Apple starts gapping up. And what I love about ADX is, you know, how many times when you just look at price action alone, and you see, oh, gee, it's flattening out. It's lost its momentum there later that session, and you kind of lose patience with the trade because you're just looking at price action. You know, if you just look at price action, you're going to become reactive like so many other average, mediocre, or worse traders, frankly. You know, I don't believe in just looking at price action when you've got a nice filter like the ADX is saying, we're still going up here, folks. You know, be patient. As my mom said, patience is a virtue, possess it if you can, rarely found in a woman, never found in a man. Okay, well, we need to push ourselves to follow the indicator like ADX to stay patient, okay, to make sure that we really follow the indicator. If you follow the indicator more than the price action, I think you're going to find that it will serve you a lot better than it will hurt you because you'll see that it keeps you in through that consolidation and then it's blasting the next day, starts gapping up the following day, and then look, rollover happening, a few bars in, we're out. And then look, it's just kind of dead money there, drifts against, then back up. But basically dead money, if you're sitting on an option, you could be rolling that money into something else. So that was a 102% gainer 3 days after we got into the 142 call. Now the 142 call on the weekly options, the stock was trading a little over 147, looks like about 147 and a half. So again, if it's worth $5.50 intrinsically, we're paying about $6 for it. You're back into that mode where you're saying I'm paying less than 10% of the option as extrinsic or time risk, and more than 90% of my option is intrinsic value. On Apple and Facebook in particular, they're in that range where they're really, Netflix as well, that they're basically, you know, we can get a real nice bang for our buck without a lot of time risk. Google and Amazon, we're trading them a little closer to the money because they've gone up so much. Now, before I get into, you know, the live charts, I want to mention, if you're new to weekly options, this was a huge breakthrough years ago. That it used to be that the third Friday of every month would be the monthly expiration, and I would only do the strategy on the third week of the month because I'd have to wait again for another month to do that. Now, weekly options are listed to expire every Friday, so the 2nd, the 9th, the 16th, the 23rd, the 30th in this particular look-back month. That'd be 5 different weekly cycles. And the Fang names all have weeklies going out at least a month ahead, if not more. A lot of other ones, they might just list them on the next Thursday to expire the following Friday, but the Fang names are so popular that they already have weeklies out there a month plus in advance. So every single Friday becomes an expiration Friday. That means that basically, like I said before, we could trade a weekly and be in and out before that next earnings, or we could basically wait until we got through an earnings to trade the weekly after that. So basically, it allows us to take advantage of events, but really, more importantly, get in and out before the event or get in after the event. We don't want to take that gap or event risk. We're just focusing on the big 5 Fang equities. You could do this on a lot of other indexes and ETFs, so we're keeping it simple here. Now, what do our alerts look like? we're very specific in the way that we call out our alerts. So this was an interesting example because I mentioned to my other BigTrends team that this was the first time that I actually bought an option. This is buy to open. BTO is not Bachman-Turner Overdrive for you rock and roll fans. It's buy to open. It's basically saying, look, Amazon week 2, we're buying the 1005 call. This is the first time I'd ever had a $1,000 plus recommendation on an option because before it's like, yeah, they're so expensive, I'm going to stay away from them. We're saying, look, we're able to buy it at less than 9. Actually, we said buy it up to $9 or better. If you're buying, that means or better means you're buying it at 9 or less. Okay, and we send these out right at the half-hour point when we get a signal. So if it happens at 10:30, at 11 a.m. Eastern, at noon Wall Street time, we're going to fire it out to you real time. And that's where, if you're afraid of missing a real-time alert like that, not just a BTO buy to open, but also a sell to close when we're getting out, everyone will be STC, sell to close, that we're going to say, okay, look, we know we need to go ahead and take advantage of that because that's going to be, the opportunity. If you're afraid you can't take advantage of it, then basically you can see that that you might want to check into what's called auto trading, where you can have a couple of brokers who can get you in and out automatically. Check with Chris Sayre, my lead consultant, about auto trading if you want more information about that, because we send an exit on everything. We never leave you hanging. So when we think of the key elements to Fang, and particularly Fang option trading, one of the big ones is there's got to be a catalyst. Now, clearly, the catalyst we're looking at is not so much fundamental, because we want to know that our pattern is correct. You'll see in Apple, for example, in a minute, exactly what I'm talking about. We're looking for that breakout or breakdown. We're looking for that momentum shift for these Fang names. As much as we can, we want to buy it in the money and still pay no more than $1,000 a contract. If we have to buy a little closer to the money and still pay $1,000 or $900 on an Amazon or Google name, we will. But the higher that delta is, the more it gives you more of a true, what we call stock substitute position. So you can really get a nice lease it instead of own it mentality. Now, these dynamic exits are driven by the ADX indicator. So we're not focused so much on price action. We're focused much more on what's happening with the ADX. We will put those trailing stops in, though. If we get to a certain profit level, we don't want to give back too much of that. So you will also see us sending out email and text alerts to say, go ahead and manage that accordingly here, okay? And then, if we got a really crazy windfall game, we would consider taking that out. But we really like to not have a target mentality in place. We like to give that ADX indicator a chance to keep running. And then we give you video training every week. I do a special Fang options video where I update all the open positions, update everything we close, update everything we're looking at with the current Fang names, so you know where we stand. Now, let me just do a quick little, now that you know a little bit about what we're looking for with the ADX indicator. I've got multiple indicators on this chart, but the bottom one is the ADX and the DMI lines. And Apple had that big gap on the earnings, didn't it, today? You say, well, why aren't we getting a buy signal on that big gap up? ADX has turned up. But notice ADX has turned up, but it was not below both of the DMI lines coming into that news on the 30-minute chart. I've got the daily chart over here, too, just to give you a taste of what we're looking at. Now, just to give you a little history, part of what we do is we do a lot of back testing and studying past performance. You see, it's been a little while since we had an Apple signal. But bottom line is that what we'll do is we'll go back and test how do we do in our bullish entries, what are called long trades here in TradeStation on Apple on the 30-minute chart. That's going back to 2002, okay? So we have 15 years of data here. And on their short trades as well, both of them have made money. And we will actually look at what we call the equity curve as well, which shows you how's your overall build in your portfolio going, what kind of drawdown risk do you have, how much money does it make through that particular cycle. And of course, it's good that it made money on both sides. It makes sense. Apple's been a pretty big winner on the upside. That, of course, 2/3 of the profit are being driven off the bullish or long trades. So we'll look at all that, and we want to see where it's got a nice big average win to average loss ratio, where it's making a lot more when you're right, and when it's wrong, it's not knocking you out as quickly. So like you go back and look at some of the other times where we did get signals on Apple, you can see here like the 10th in and then flipping real quickly again. So there's an example where you're in, the stock's at about 145.25, you're out, the stock's at 145.09. We basically scratched out of that trade. That's a slight loss on the stock. I think we actually were able to get out at a slight profit when we got our exit fill. But bottom line is that that's a scratch. We're moving on. This next one was a slight profit. You see 146.70. It's out later that day about 147.70. Stock's up about $1. That's why buying that in the money is going to give you a more immediate bang for your buck working for you there. Okay, if you look at the other big FANG names real quick, Facebook, as we said, Facebook we avoided before the earnings. You see it's getting those little signals here on the 30-minute chart, but we weren't trading those a couple of days before earnings because those options were too expensive, and so we skipped those. Good thing we did. We did get into this one right after the earnings because now the earnings are behind us. ADX is turning up, and we lost on that one. Okay, that's going to happen sometimes. I want to show you that when we lose, about maybe 2.5 hours, no more than 3 hours later, we're saying, get out. It's not worth hanging around anymore. At that point, it kind of chops around, but you see it's edged down a little bit as it didn't get the follow through that we were expecting after that initial pop up on the really strong earnings. So that can happen. Okay, but just be alert that, you know, we'll tell you to get out even when it's not working. Okay, we're going to control that risk that way by not being in a trade too long and you don't get stuck in hope mode. Like I said, on Amazon, it was trying to give a buy right before the earnings. We said we don't want to pay up for those earnings, so we didn't take that signal. But basically, you go back and you see some of the other ones where we saw it did get a nice little lift, and go back to, of course, times where, you know, we get this question a lot. Why didn't you get bearish right here? You could have made some money on the downside. Well, it's just above our moving average filter in light blue in the upper panel, so we don't want to do that and then get basically a bounce back in that long-term trend. So it filters out some otherwise potentially noisy signals. Netflix, another one, we're kind of waiting on that next signal. But you see, it's consolidated right back to its long-term trend line. The DMI line's like negative. ADX had one brief little upturn there, but you see it really wouldn't have resulted in much. So this kind of really picky type of behavior is what has served us so well to control our risk and still be around for those big potential wins. You see Google, again, getting a couple of winning trades actually earlier this week, but again, with the earnings, like we said, we just basically wanted to not take this trade right in front of earnings. Good thing, right, because it gapped the other way. So that saved us in a big way, and now you see the trend is starting to work negatively on Google, but it's not quite where we need it to be on the ADX line, setting up with the DMI potential. So just a quick little overview, and again, you know, you go back and you look at all those. Here's the Google 30-minute history. You know, it's made money on both sides. You know, the performance history shows a pretty steady equity build. All those green dots show you new equity highs, and Google's been quite good through that. So we want to make sure to keep that on board. Now, you know, we get questions about, okay, so for people coming in late that might have missed what I was sharing earlier, you know, the kind of consistency that we've been able to make money 9 of the last 12 months. Since we started doing this 12 months ago, so we're basically 75% profitable months. What I like is that, sure, if you take your worst give back month, 560, take your best profit month, it's about double that. You know, so a March up almost $1,200. You know, so you see several others that are up like almost 900 in September, 828 in May. You know, some 500s. You know, yeah, and the other couple losses pretty small, 148, 290. So that's a kind of, you know, keep losses small, let winners run approach that as a trend trader is going to really benefit you dramatically over time. I'm going to come in and answer some questions here in a couple of minutes, but I want to show you how to take advantage of this kind of equity build-up opportunity. Like I said, this is just over the past 10 months. I didn't update the prior two. That was more than $500. It would put you up plus 4,400 over the last year. Again, whatever capital base you want to start for, that's gross profit. You got to take your commission out of it. If you're paying too much for your commissions, check with Chris Terra, my lead consultant, because you want to make sure to keep your commissions down. This is a single leg strategy. We're just buying, going in on one option, we're selling that same option to close when we come out of it. So we're keeping it really simple, reducing your commissions by not having too many legs of the contract, so to speak, to worry about. But you say, okay, that's you know, potential big time market beater. You say, okay, so you know, usually if you go to our website for our Fang options trade service, 12 months would cost you $9.95. You know, for a 1 month access, I should have written in here, 1 month access, you can do it for $99 a month usually, but I'm going to allow you something special here just to try it out month to month to say, okay, if you like it, I'm going to let you basically stay with it for this incredible starter price point of just $69 every 30 days. Okay, so I'm going to basically say that's going to become your best value over the year at $1,000. I'm going to say, look, start at just $69, try it for the next 30 days. What are you going to get? You're going to get at least 8, probably more like 10 trades each 30 days. So, you know, your average cost per trade is in the neighborhood of about maybe what, $7, no more than $8 a trade. You know, but pretty much, you know, give you great value per trade. I'll give you a weekly video so you can take advantage of that and really allow you the opportunity to really start leveraging your your capital into these best of the best Fang names. When you go to that special page that Chris is going to post for you here, bigtrends.com/Fang Options Trader. That's the name of the service, Fang Options Trader. So we've made that the name of this page. As we said, you can go there, you add it to your cart, and it's just a every 30 days, 1 month subscription. It does auto renew, but you can tell us if you don't like it that you want to hop out within the first 30 days. We'll just cancel any future auto renew, and you've just tried it for a month for $69. And you can see, look at what you're getting. You're getting at least 8 trades a month in just those exclusive 5 Fang names that we like to focus on, using this unique DMI ADX-based approach to find the strong directional movement-based momentum. And all the contracts are $10 or less. So that means that you're never going to pay more than $1,000 into any trade, which means that, like I said, if you're doing a $10,000 model portfolio, that's no more than 10% of your capital into any one trade. The beauty of this is that in addition to the quick holding periods, 1 to 3 days on average, I'll never carry more than 2 open trades at once. Even if I'm getting signals across all 5 of the Fang names, whichever 2 give me the signals first, I say, okay, I'll take those 2, and then we won't overcommit you ever. So that way you're not totally loaded up and totally invested into all 5 names, and if the market goes haywire, that you don't get whacked all at once. We're very sensitive to that risk management always. So 1 month auto renew, usually be $99 today. You get it for just $69. Try it out for the next 30 days. What I find is that we don't do free trials at BigTrends because basically it's whatever you value, if you put a little money into it, you're going to actually follow this. You're going to actually learn about it. You're going to study it. So it's a small investment. As you know, you can make that back many-fold over in the examples I showed you in one trade. If you buy one of those Apples or Amazons, it doubles, and $1,000 turns into $2,000 potentially very, very quickly. But we do this because we find that people love the month-by-month auto renew. It's very convenient. It's a great way to get started, and I'm going to honor that $69 going forward too. So if you like it as much as a lot of our Fang subscribers have, you're getting great value month after month at just $69 every 30 days. That's just automatic, and if you don't want it, you can let us know. I'll show you how to do that too. So you can see a lot of the examples on that page. It shows you how you can basically get that. It's $199 value with all the other good stuff that we add in, so you're getting it at a big savings. Because we call it learn while you earn. I don't just want to fire out trades in a black box system. You get the ability to learn what the settings are when you become a subscriber, even at just $69 for a month, and then you can basically follow along with us on your own charts. You could use the same methodology on any time frame chart you want it. You could do it on dailies, you could do it on hourlies, you could do it on 5 and 10 minute charts if you really want to focus on that yourself. I like to get good bang for my buck, not just return on my investment, but return on my time. So that's why we like the half-hour chart. We don't have to monitor it too much, and every half hour when we get a new signal, we fire out those alerts to all of our Fang option subscribers at the same time. So all you do here is you go to that page, you see the orange add to cart button, left click on that. It's really simple. We've already taken the best coupon savings on it for you, and basically $69. If you're not in Kentucky, there's no taxes, no shipping, as you're getting real-time access to this. And I'll show you the member page here in a second as well. And then basically you hit that green checkout button. You're on our secure page at that point. You can see secure, get your information in there and whichever credit card you want to use. So bolded information. We double confirm your email to make sure that you're going to get these alerts that way. Show you how to get text in a minute. We take all your major credit cards. And then, you can just say, okay, you saw it here on the webinar, or you saw it with me here presenting this to you. And I want to show you, if you want to get text alerts to your smartphone, no additional charge from us. Just make sure you've got unlimited text on your smartphone plan. You can say text alerts to whatever your number is, so whatever it is, 1, 2, 3, 4, 5, 6, 7, 8, 9. But basically say, tell us also which service you use, if it's AT&T, if it's Verizon, because we put all of our different text services on different batch lists. So when we hit the send button on everything, it goes out to all those lists at the same time, but basically we make sure it's going to get out to you the fastest way possible. And we spell out our terms and conditions here down below the submit order link. And so review those terms and conditions, please, because it's important. We're very transparent about the way we do business. I've even pulled out some of it here in particular about automated renewal programs, because that's what this is. Every 30 days we bill at $69 unless you either email us. You can see you can email us in here. You can fax us some kind of written instruction, or email or send that email into client care if you basically need to stop that auto bill, then we won't bill you any further. It's very simple. So review that. It's really clear. If this is not for you, you want to stop that, just do that. And then once you review those terms, click on that, and you can hit your green submit order button right under the $69 for the next 30 days price, and then every 30 days thereafter until you tell us if you tell us you want to cancel. We've got a lot of people that stayed on there with those kind of results for many, many months. Now, also we're getting questions about, so what do I get here? So in addition to getting your access to real-time email and text, you get a members access login, and you see I've got access to everything, of course, but bottom line is our member newsletter, Fang Options Trader. Left click on that, and you'll see that you'll get these updates coming into you every single week. So basically you'll get these updates. You can click on that, say the one that I just did for Monday, and basically it'll give you a video here that you can go watch. It'll give you our Fang performance history here. You can see, basically positive equities, we said, both for June and July, even with that little Facebook knock that we took right near the end of the month after the Facebook earnings. We were still positive nicely in July, positive in June overall. And what you see on this, by the way, when you look at it, is some small losses, some small wins, and then some bigger wins, the occasional, pop against like Facebook. But all in all, pretty effective at kind of grinding out gains through any kind of market environment. So go to that page. Let me go back to the main page here and see what other questions I might be able to answer for you real quick. So John B says he's going to be on vacation for a little while. Can he still take advantage of it? Yes, you can, John B. What you do is you'd sign up here and basically get started, and then basically call us and tell us you want to put the subscription on hold until X date when you come back, or contact us when you want to come back. So we do that where we'll put it on hold, then we'll restart it if you need to, especially in this kind of vacation season. Okay, Kay says, do we add our other studies with this? I think you're asking for like all of our indicators, Kay. We don't do that with this particular offer, but you can get all of my BigTrends indicators. We call it our BigTrends toolkit across multiple major platforms. Oh, the other indicators are on there, CCI, %R, et cetera. You can get that as part of additional training, Kay. Whether you want our boot camp series on all of our technical indicators or other kinds of training, just contact us at our toll-free number, which you see. Our toll-free number is 800-244-8736, top right of the screen. But if you can't remember that, I've got an easy way to remember it for you. We made it 1-800-BIG-TRENDS. Okay, so just on your phone, if you dial 800-BIG-TRENDS, that will get you to us toll-free. You can email us anytime also through the client care at bigtrends.com access. Going back to other questions here. From the time the trade alerts received, Vivek asks, how quickly should you get into the trade? I want you in right away, Vivek, because my concern is, of course, when you start playing the second guessing game, that basically you will see, if we go back and look at, other examples here. Let's go back and look at another example just we showed you just for a second here. Let me pop it back up here so we can see a chart. Okay, so like, for example, you go back in here, you say, okay, look at this Apple example here. You're getting the signal. It's up a little bit, it's down a little bit, things are bumping around, and you're basically in one of those situations where you say, okay, if we're bumping back and forth here, you're tempted to say, well, when it's going for you, like, okay, well, maybe I can buy it as it comes back down. When it starts coming down, you go, oh, it's starting to come down, maybe I'll wait. Then it launches and you're not on board, and then you're going, now what? Okay, that's the second guessing that I'm basically trying to say. This system gets you out of second guessing. If you just follow the instructions, you get one of those trade alerts coming in, and it says, okay, I know I need to go ahead and take the signal. That's basically getting your ego on the sidelines. That's hard for a lot of traders to do. Again, I promised to talk to you about psychology. Ego is the thing that's costing you a lot of money, as well as costing you holding on to too many losses in your portfolio, because ego wants to be proven right. Your ego it's all your ego wants is to be validated, to be proven right. So ego will cost you to take your profits too quickly. It'll say, oh, okay, I made some good money in the first couple hours on Apple here. I'm going to book my profit here for a 25-30% gain. And then you left an extra 70 percentage points on the table by the time that the trade was giving its official exit. So your ego doesn't want to acknowledge that it left money on the table. It'll just kind of make you duck your head and go, let's not beat ourselves up about that. Also, ego, if you're wrong, you start getting off the wrong track, ADX turns down, and you go, oh, well, it's Apple. It's a good quality company. It'll bounce back eventually. I'll hold on. Big mistake. right? You've got to follow your rules. If you follow your rules, your life becomes immensely simpler, right? Like I said before, the keep it simple mentality to your trading, one indicator, one option to buy, sell it when it says to sell it. That KISS principle and this whole Fang options trader approach has made not just our life easier, it's made our subscribers' life so much easier, where we get an immense amount of positive commentary. And thanks, Earl has the toolkit with all of our indicators in his comment. It says he loves it. So we appreciate that. You can use that as well. Thanks for the nice comments. Now, we see also a question from Bob. What's a longer-term moving average? So again, we give you all that as a subscriber. When you come on board on that special offer, you're going to get all those settings. So basically, the long-term moving average, it's not mega long-term, but it's long-term enough to filter out against a 30-minute time frame that we're looking at over the next 2 or 3 sessions. It's basically saying we need something that's going to give us a little more perspective as well, to say, let's not make the mistake of trying to short something when it looks like it's rolling over, but it's still longer-term positive. A lot of traders have made that mistake in front of our presidential election and after it, where a lot of people said, oh, well, there's no way the market can go up now with this new president, yada, yada, yada. It's been an absolutely beautiful bullish time for a lot of these trades. But we've also had bear trades too, so bear trades can happen. Obviously, the bias for us when we look at the sales page has a lot of the different history. Yeah, there's a definite call bias there. But usually we still made some money on puts on Netflix. We recently had one on Google and more. So basically, they're there. It's just that obviously if the bias is to the upside, we as trend traders are not going to fight what the market is telling us. We're going to follow what the indicator says. Trend trading as a trend trader, you have to follow that momentum. If you fight it, you're asking for trouble. If you follow it, you can open yourself up to a world of opportunity. And when the trend ends, when the ADX rolls over, I don't second guess. I get out, I move on, and follow the next trade. So I've got a minute left here for what Dan said, and basically just remind you, if you go to bigtrends.com/Fang options trader, you're going to save 30% on the usual 1 month price, and I'm going to honor that going forward. It's not going to ever go up on you, and you can get out at any time. If you don't like it, we'll never auto bill you again. So it's really clean. I started BigTrends in '99, been in business now in my 18th year here. And bottom line is that we're here to help. So if you have questions, call us at that toll-free 800 BigTrends number. Chris there, my lead consultant, has been with me 6 years, known him for a couple decades. He does a great job getting our clients set up. If you got questions about how to set up your brokerage account, if you want to take advantage of the automatic in and out that auto trading can benefit you, so you don't have to lift a finger, the broker can do the work for you. Ask Chris about that. And any other questions you have, email us or ask us. We're here to help. We're going to honor this promo, Vivek, for this week from the MarketFest. If you have questions on it, just let us know. And thanks. I want to hand it back over to Dan. Great job, Dan, you and your team do at MarketFest. A great bunch of presenters. I know we got another great one coming up next, so don't miss that. And if you have any questions, just drop us a call or an email, 800 BigTrends or clientcare@bigtrends.com, or go to bigtrends.com/Fang options trader and get started trading the big tech names that are really driving the market's gains in those big 5 Fang key vehicles. So thanks, everybody. Appreciate the kind comments and hope to see you again real soon. Back to you, Dan.